My name is Richard Brandweiner and I'm the CEO of Pendal in Australia. And welcome to Pendal's first advisor briefing for 2020. Today we're going to be talking about the very topical idea of sustainable and responsible investing. As you know, this year's been a very difficult start for many Australians and we're getting increasing amount of queries from investors and advisors about how they can ensure that they invest in ways and deploy their capital in ways that actually creates positive outcomes alongside generating strong financial returns. And ultimately, this is the purpose of sustainable or impact investing. As part of this, recently Pendal fully acquired an organisation known as Regnan. Regnan is one of Australia's leading ESG research and corporate engagement providers, which we actually helped establish many years ago. We did this in order to bring together high quality ESG research closer to our traditional fundamental investment decision making, and so improve the quality of both. And this year we'll start to bring to the market dedicated and specialist impact investment strategies through our Regnan brand. So thank you for your time, and I'm now going to hand over to Alison, Edwina and Jeremy.
Welcome Edwina, welcome Alison. Alison, I might start with you.
Sure.
What is responsible investing and how has it evolved over the last decade?
Well, essentially responsible investing is about taking into consideration environmental, social, governance and ethical factors. But how that's done is really varied. So there's lots of different options that can be considered responsible investing. More traditionally, it's really been a focus on what you haven't invested in. So you might be screening out things like tobacco or weapons, for instance. Then after that we started to see more of a focus on actually what it is you are investing in. So whether that be rewarding companies for their sustainability performance or tilting towards things like healthcare, for instance, or renewable energy. And as the sector became more familiar with environmental, social and governance factors, I actually realised that there were some things going on in this space that actually are also material to mainstream investment performance. And so we see the rise of ESG integration. And finally we're seeing impact investing products. So that's really where you're focused on receiving a financial return, but also quantifiable environmental and social benefits as well.
And Edwina, how have we seen fund managers and suppliers respond to the changes in the dynamics?
I think the evolution is as Alison shared with us just then. In the advisor space, we've definitely seen a growth beyond just what to exclude. So, alcohol, gaming, tobacco, focusing on how they can contribute to solutions. Both through the sustainable sort of thematic type of strategies, whether it's renewable energy or healthcare, to also impact investing, where you're actually going in with a specific environmental or social objective alongside financial returns. And so we've seen growth in that considerably, and probably impact investing is the largest growing category within the responsible investment spectrum. But when we do look at also the ethical and exclusion type of strategies, we are seeing an evolution there, which historically was, I guess, focusing on the tobacco and weapons, but we are seeing a lot more focus now in terms of fossil fuels exclusions, starting with thermal coal, moving along to oil and gas, as well as human rights, which I think comes from the introduction of the Modern Slavery Act in Australia last year.
And Alison, what is the Modern Slavery Act and how should advisors be thinking about it?
So the Modern Slavery Act is really a piece of legislation that was introduced at the federal level, asking companies to report how they consider where their business might be supporting acts of modern slavery, as the name suggests. So that can be in their supply chain. If they're in the finance field, it might be how they invest, or it might be the types of activities that their customers undertake. And so really what companies will be required to do from this year is to report how they seek to understand where their business might be facilitating modern slavery, either directly or indirectly, and how they manage essentially the efficacy of that approach. So it's about disclosure, but it's also about improving practice as well.
Climate change is obviously very topical at the moment. What conversations are you having with corporates and how are they responding to the challenges of climate change?
We've been having conversations with companies about climate change for over a decade, so it's not a new activity for us. I think what we're seeing is that it's more well recognised at the board. But I think what's really interesting about an issue like climate change is actually that it permeates in very different ways for different companies. So for some, in fact for the majority of companies, it's actually around the physical risks of climate change that, and the events of the recent months have only demonstrated what that can look like. For others, it's more around transition. So if they're in a fossil fuel intensive sector, what are the kinds of skills or analysis that needs to happen to help them transition as we see less demand for their product, essentially. Likewise, if it's a second order impact like a financial services company, what kind of analysis are they doing to make sure that they minimise their own risks to climate change? And that might look very different for two companies in the same sector. So if you've got two banks, one of whom has a very large agricultural exposure, one of whom has a very large mining exposure, then the way they manage those risks is going to be really different.
Edwina, is investing for a lower carbon economy more than just not owning coal?
Most definitely. Alison touched on the difference between physical and transition risks when it comes to climate change. So you can, as part of an investment strategy, divest from coal, and that reduces certain exposure. For example, from stranded assets that might result as we do move along the decarbonisation pathway. But it doesn't necessarily insulate you from physical risks. Or second order risks. You might have, it might be a company that might be transporting the coal, from the ports, from the mines to the ports, or it might be a utility company that's heavily reliant on thermal coal as a source of electricity generation. So it's really taking each on a case by case basis and understanding the business model and how it operates, but also how they are transitioning their own businesses. So just because you have an exposure doesn't necessarily mean it's a reason to divest from a risk point of view if they are managing that exposure and they're working, as I said, towards transitioning to more sustainable products and services. So that's what we're seeing in terms of the advisor interest and their end client interest is really looking towards different ways that they can align their investment strategies in terms of how they see climate change, whether it's reducing risk by not owning fossil fuels or from a brand or reputation risk. Sometimes they don't want to be associated with fossil fuels, but then it's also investing towards positive solutions. How can they allocate capital so they can contribute to on this transition pathway, whether it's through, as we said, renewable energy, or it might be resilient infrastructure. All of these needs we've seen as a key part of how we're going to transition to a more sustainable future.
Great. We've talked about climate change. What are the other big issues that we think that we'll see in 2020 and beyond?
Look, I think it's always important for advisors to be across what the likely topical issues are, because it's the kinds of things that their clients will be asking them about. And so in addition to climate change, as we mentioned before, it's things like the introduction of the Modern Slavery Act, because we think will set more media coverage around human rights issues generally. I also think things like privacy issues that we've seen out of the tech sector and the governance around data and cybersecurity is also certainly a big focus of the population generally. But it's also important to remember that when you are then thinking about that from an investment sense, it's not as easy as the kind of top 5 issues list that people like to seek reassurance from. It's actually about who has the ability to think about what issues are going to be most material to which companies, because it's not going to be a blanket rule. It's far more complex than that.
We've seen some failures of corporate culture in the last couple of years. We've seen a result of royal commissions into some of those sectors. What does conduct and culture mean, and how do we see it playing out?
This is an area that's moving quite rapidly. So if I think about when we first started talking to companies about this 4 or 5 years ago, definitely the responses that we would have got were that we appoint the CEO, they set the tone, that's the most important thing we can do as a board. Sometimes things go wrong, there's some bad apples, and we deal with it and move on. We almost never hear that response anymore. There's a real acceptance amongst the director community that boards have a stewardship obligation over the culture of their organisations, and what we're seeing is a phase where they're working through how to do that. So it's a perfect time for collaborative engagement to support them in that process.
Edwina, climate change, Modern Slavery Act, what else are we seeing in 2020 and beyond?
Yeah, I think waste management is probably another theme we'll see this year. It was in the media a lot last year and starting to move on to most companies' radar. But in terms of like responsible packaging, reducing recycling content, that's increasingly in terms of companies, how companies are being judged in terms of their social license to operate. And the end consumer is being pretty blunt in terms of how they're purchasing decisions. Other themes that I think could be on the horizon as well, we touched on data privacy, but cybersecurity and related to that. We've already seen an incident already this year where a ransomware attack disrupted business for a number of days, but the flow-on effect from that as well can impact a number of other companies as well. So it's really related to not just the one slave, but understanding your supply chain as well.
Edwina, do you have to give up performance to invest responsibly?
It's one of those myths that is out there, and we hear it time and time again. The academic evidence and also our own research in terms of our own investment strategies has shown that you don't. A key part of that is, it comes down to also the quality of the investment manager. Like any type of, style or strategy, when you are narrowing a universe, there are diversification issues you do need to take into account. But we have found that within our own strategies that there is no performance penalty. And actually, I think we're at a tipping point where people are actually thinking that it could be an actual absolute sense source of alpha, in that by seeking out the more sustainable companies, those that are thinking about how they're managing climate risks, that actually they could outperform. And the data that's come from RIA in terms of looking at track records of performance has found that for most asset classes and over most timeframes that there is no performance penalty. And actually, last year we even had a first, what people dubbed as the first climate change bankruptcy, which was a utilities company in California that has gone bankrupt as a result of mismanagement of its own climate resilience strategy. So I think people are understanding now that this is not just a good feel-good type of strategy. This is actually prudent portfolio management.
And this is true for equities. Is it true for other asset classes as well?
Most definitely. We've found consistent value added to be had in, for example, our fixed income strategies, and that's both at the govie and semi levels as well as at credit. We've also found significant, really solid demand for what we call green bonds and sustainable bonds and SDG bonds, which are just a regular form of listed credit, but actually have underlying projects that are supporting more sustainable outcomes, whether it's through renewable energy or some form of social outcomes, health and well-being or education. So we've found that there's been no performance penalty on that side, and actually at times they've actually traded tighter. So more and more as the industry evolves and the solutions out there evolve, and also the data improves, we have been able to develop more robust and more transparent sort of processes in terms of how we're incorporating these risks, ESG risks, into our processes, and hence how it contributes to performance.
Jeremy, I just echo that to say that where you are looking at ESG factors that are material to performance, actually you're making better decisions. So it should actually be supporting better performance outcomes.
We've seen a significant increase in the issuance of green and environmentally friendly bonds by major corporates, supranationals and so forth. What are the types of bonds that have been issued, and what's that money being used for?
It's been a vast array of projects that are behind a lot of these instruments. In the green bond space, a lot of it has focused on renewable energy and energy efficiency measures, and that's ranged from universities issuing these structures to help in terms of their own environmental efficiency programs on campus, to corporates, like Woolworths, for example, that issued its own green bond that helped in terms of its energy efficiency initiatives across its organisation. Green building is a big one, as well as transport. Sustainable transport has also been a feature in some of these underlying projects. We've also seen R&D focusing on supporting breakthrough technology in this space. We need to scale, and we need to drive down the cost of some of these technologies, and so the R&D is an important component of that. On the social side, we've seen housing, affordable housing has been a big one, and we've been quite active in that space. Healthcare, mental health care is another one increasingly, as well as Indigenous communities programs as well, supporting both education, health, housing within those communities as well. Education is another one in terms of both access and affordability of education. So we've seen quite a vast array of projects. There's also, we haven't seen one here yet, but I imagine won't be much time before we do, is blue bonds, which are to do with the ocean. So for example, in Sweden, the City of Stockholm issued a blue bond that was raising capital to fund upgrading in terms of infrastructure to stop storm surges, water coming into and flooding areas of the City of Stockholm. So I can imagine, given what's going on in the Barrier Reef and the degradation there, that's a possibility, I think, in the future that we might see some blue bonds coming into our market as well.
And do those bonds, how do they trade relative to a normal senior bond issued by a bank?
Pretty much the same. At times early in the market, in the evolution of these structures, they were actually trading tighter. That was more to do with the demand versus supply imbalance. But most of the time, they're actually trading on the curve with an increasing demand as well, especially across the investment management and on superannuation funds. There's a growing demand for these types of instruments. And I think what's helped is the transparency. They go through quite a rigorous process for certification and insurance, and that involves the ring fencing of these proceeds to particular projects. One of the ways that we've been engaging in the fixed income space as well has been with the issuers of these type of instruments, because one of the things we want to see is improvements in the disclosures around these. So in terms of, okay, these are the projects you're financing, but how are you tracking in terms of the allocation of that capital, and are you reaching the objectives that you'd hope for in terms of whether it's take-up of affordable housing units or avoided emissions in terms of some renewable energy projects. So that sort of impact side of it, in terms of having targeted environmental or social outcomes, is something that we're also engaging with a number of issuers to increase the quality and the timeliness of those sort of disclosures associated with these type of instruments.
A lot of those projects sound quite complex. What sort of risks associated from an investor's perspective? You're lending the money. What's the risk?
The risks for these type of instruments, the risks are just the same, because you're facing against the underlying credit of the organisation. Where people have raised the issue of risk is more around the social impact bonds, which is a different type of instrument. That is where the actual payoff, both in terms of the yield you get, is a function of reaching certain hurdles, and that's a very different instrument to the ones that we're investing in at this point in time, which are just general purpose type of instruments.
Edwina, as Pendal being an active manager, what does it actually mean being a steward of capital?
As an active investment manager, we see active ownership, whether it's how we engage with companies or how we vote our proxies, as part of our fiduciary duty, really. So when we engage with companies, there's probably two drivers there. One is really a fact-finding exercise. It's so we can better understand the investment thesis behind our interest in the company, or it could be to do with our risk assessment process. But there's also the aspect of engaging with companies to provide feedback as well, and to support them in terms of value creation in the longer run. Because we, as an active manager, we believe that there needs to be a two-way dialogue. It's not just about passively getting information from companies, it's providing feedback in terms of what we see in terms of best practice, but also where we see the risks and opportunities.
As head of engagement, what does engagement mean?
Typically for our clients, engagement forms part of their active stewardship program. So that's really about owners taking a more active responsibility for the companies that they invest in. In this sense, it's really around trying to identify issues that they think might be problematic for the company in the future, or issues that they're not managing satisfactorily now. And so we will go in on behalf of a range of investors typically to talk to businesses about those concerns in a collaborative way that tries to create strong solutions around those issues.
And how do they respond? What does good engagement look like?
It's I think the fundamental is that it's well researched. So you're not going in just to talk to a company for the sake of talking to a company to say that you've engaged. You're going in with specifically defined objectives about what the issues are that you want to see addressed by the company, that you've done it in a way that's collaborative. So it's in any investor's interest for the companies in which they're invested to do well, and so you want to go in a way that's constructive, and that's a really important feature of our engagement.
Alison, we've talked about engagement. What does active ownership actually mean?
Well, I mean, in some ways it means exactly what it says, that it's about companies taking a more active responsibility for the investments that they hold. But in practical terms, that means a range of different things. It can be engagement as one of those tools, talking to companies, as we've talked about already today. But it can also be things like taking an active consideration in their voting decisions. It might be to the extent of nominating a director for the board or putting forward their own resolution at an AGM. And ultimately it can be about reaching a decision around how much of a stock you want to hold, if any, if you're finding that the concerns that you're raising aren't being addressed. Another important feature of being an active steward is to actually make sure that what you're doing is impactful. So in the engagement sense, it's not just about meeting companies, but it's about monitoring to see whether or not they are really making changes and being publicly accountable to that. So we go through a process each year of making sure or checking again where we are against our engagement plans, and we publicly report those so that we can be transparent and accountable for the work that we do on behalf of investors.
It's a good point, because as an active manager, our business is about taking risk. We just want to make sure that we're paid for the risks that we're taking. So we actually find that in a lot of these cases that the sustainability theme is actually quite a powerful source of alpha, because when you do see companies transitioning, and they might be transitioning ahead of where the market really thinks they are, then that's what we think there's a good opportunity there as well. And so by engaging with those companies, understanding where they're at and supporting them on that journey, we actually think is an important part of our investment process.
Thanks for your time. For more information, please contact your Pendal BDM or look for contact details on the page.